Shares of Tesla, they're up after a surprisingly bearish take from Morgan Stanley.
In this video, Tesla stock flips in a catastrophic blow to technical analysts the world over. Did I pronounce that right? Oh no, anal cysts. Morgan Stanley follows the herd and reduces their Tesla stock price target in a new research note. And Elon Musk low-key confirms plans to compete directly with YouTube. Really? We have a lot to discuss. So do I. That's why I posted yet another exclusive video on Patreon this morning, almost 20 minutes. You do not want to miss this one. You can join with the card in the corner or the link in the pinned comment. So Tesla stock today miraculously defying the predictions of technical analysts the world over, somehow reversing the chair leg drop off the left nut, up over 5% today, proving that the simulation is definitely real. Tesla's current market cap as I record this, $69.69 billion. Clearly we live in a simulation. Just to provide some additional context, I mean, I've literally been saying it now for months. In my opinion, Tesla stock, best risk-adjusted opportunity in the market that I'm aware of. I also really do get the feeling this stock is rather spring-loaded. Now, this isn't a prediction of what's going to happen. I'm just saying, personally believe it's only a matter of time. Year to date, Tesla stock down about 45%. Even over the last 12 months, down about 35%. Despite near flawless execution. Now, some guy on Twitter, never heard of this dude before, I don't know who he is, but anyway, he posted some catalysts about Tesla stock. Maybe some things that might very rapidly relieve tension in the stonk. Let's read these Tesla stock catalysts. Twitter overhang lifts in October. By the way, that's this month. 2023 EPS revisions for Q4. New Gigafactory announcements. FSD beta wide release in Q4. The $7,500 EV tax credit coming into effect in Q1. Tesla stock $10 billion share buybacks in Q1. At least more details on potential share buybacks. Cybertruck launch in mid-2023. And Tesla's robotaxi platform, aka a more affordable Tesla vehicle, around $30,000, inflation adjusted, to launch in mid-2024. Gary Black reiterating a $550 6 to 12 month price target. Just for some context, Gary and I are in the same vicinity with our Tesla stock price targets. Of course, if you want access to my price targets out over the next decade, bear case, base case, bull case, and hyper bull case, you can gain instant, exclusive, up-to-date access by joining Patreon with the card in the corner or the link in the pinned comment.
Shares of Tesla, they're up after a surprisingly bearish take from Morgan Stanley. The bank cutting its price target to $330, down from $350, citing a highly volatile economic environment and anticipating unexpected headwinds. And of course, this call comes from our friend of the show, Adam Jonas, over at Morgan Stanley, always a market mover on Tesla. He's still staying bullish, of course, on Tesla. He's been a long-time bull in this company, but really noting for what he's saying, quote, making room for unexpected headwinds in the current economic environment. I'll argue, Brad, some of those unexpected headwinds are coming out of China. We talked about China was yesterday. Tesla cutting prices in that China market. That is a complete U-turn from what Tesla had been experiencing last year and even the first part of this year.
Right. And for Tesla, they have to acknowledge what's happening in the region, too. It sounded like when they were on the call that they didn't want to really discuss what is really taking place within that region in China. And you have so much competition that is being brought online that much quicker, that is improving their capacity for production, improving their relations with customers in the region too, who have the propensity to buy some of the electric vehicles either on the mass market side or on the more expensive side. And the propensity right now is leaning towards some of the homegrown brands in the region too.
Awkward time to mention that the Chinese Tesla website broke because of too much traffic after the price reductions. Yeah, let's not mention that.
Tesla doesn't want to acknowledge that, of course. They want to continue to focus on their product, but I think it still is a realization that has to be factored in to what their forecasts are actually looking like in the region too.
Right, and I was on this too. Yesterday I mentioned that Xpeng is really going toe-to-toe with Tesla in China, and I got raked over the coals on Twitter for it. I do think folks, even the Tesla bulls, pull up some of the specs on these Xpeng vehicles. They are very impressive. That technology package in that car is very, very impressive indeed.
Compared to Tesla, not so much. Compared to US automotive manufacturers attempting to make EVs, definitely a valid point. In my opinion, Xpeng will not be eating Tesla's lunch, but Government Motors' lunch, Ford's lunch, in fact, just about every legacy automotive manufacturer's lunch. As I've said in the past, and it won't just be Xpeng, the Chinese EV invasion is just around the corner. A tidal wave of cost-competitive, relatively economical, fairly compelling, not amazing, but fairly compelling electric vehicles will be coming out of China and eviscerating sales of slow-moving legacy automotive manufacturers. So let's read this note from Morgan Stanley. Key thoughts after Tesla's Q3 and China discounting. Price target to $330 per share. Tesla's Q3 results were both stronger and higher quality than we expected. Okay, just a moment here. Wall Street underestimating Tesla again. Just wanted to point that out because it's never happened before. Albeit more in line with consensus expectations. Following the analyst conference call, we make a number of modest changes to our earnings model that, when taken together, leave our forecasts largely unchanged. The average EPS in our 2023 throughout 2024 forecast now stands at $7.11 versus $7.14 previously. We had expected Tesla to miss consensus expectations in Q3 due to input cost inflation and other disruption. This didn't happen. So just one more time, underestimated Tesla again. The company presented a rather bullish outlook for the fourth quarter and beyond, citing demand exceeding supply for the foreseeable future. However, given the highly volatile economic environment, we want to make room for unexpected headwinds into Q4 as well as in 2023. For example, we want to allow for a greater margin of safety in terms of supply chain, as well as incremental pressures from foreign exchange headwinds, input cost inflation, startup costs, and to some degree, demand destruction. Many of our clients do not believe Tesla is vulnerable to a slowing consumer due to the company's unique position in the EV market and general lack of supply. I agree. We fundamentally disagree with this argument. Of course they would. Tell you what, man, I'm sure most of the people working at Morgan Stanley have a 150 IQ and a PhD in being wrong. This will not age well. While initial signs of a slowing consumer present itself in shrinking order to delivery times, reduced order backlogs, we believe Tesla's increasingly large size today and in the forecast makes it susceptible to what could be some profound swings in consumer strength and EV affordability. Ready for the first major self-immolation? For now. Keywords for now, because these will change in one direction consistently throughout the next decade. Our long-term unit volume forecast of 3.2 million units by 2025, in what universe? They're off by at least 1 million units in just 3 years' time. It's easily going to be well over 4.2. And 7.7 million by 2030. Do we exist in the same dimension? Is this real life? Maybe somebody photoshopped this research note. They can't be serious. Can somebody please remind me to clip this early 2031? Revisit. Morgan Stanley in late 2022. We're expecting Tesla to deliver a mere 7.7 million vehicles in 2030. In my own estimation, they're off by approximately 10 million units. My base case for Tesla deliveries in 2030, over 15 million. The bull case significantly above that mark. Implies an annual unit volume compound annual growth rate of 25%, which is approximately 1/2 of the company's long-term target. Who you betting on? Big brain Morgan Stanley analysts or Tesla? Now some comments on China. Tesla China may affect already weak market sentiment. While we believe luxury ICE brands are likely to be affected more, intensifying price competition could raise market concerns on the order intake of major EV names' flagship models into the peak season. We estimate Tesla generates as much as 1/2 of its profitability from the Chinese market, arguably making the stock a derivative of a Chinese tech stock. Skipping ahead a little bit, our forecasts through 2030 become gradually less China dependent, but this takes time. Key changes to our model following Q3 results. 2022 and 2023 delivery forecast remains at 1.31 million and 1.8 million units respectively, which we had cut following preliminary Q3 delivery. So, I'm just trying to figure out how Moron Stanley get to 1.31 million units delivered for the full year, and I'm really struggling here. I guess they're assuming literally no deliveries at all from Austin and Berlin. 1.8 million units next year, a little bit closer to the mark, but I still think they're off by a few 100,000 units unless there's a few disasters we can't see coming. Gross margins. Our revised forecast assumes 2022 Q4 gross automotive margin of 26.2% versus 26.8% in Q3. Our 2023 clean auto gross margin stands at 24% as we allow for greater foreign exchange headwinds, lower pricing, and continued input cost inflation. Hilarious, considering that Elon has recently mentioned on Tesla's earnings call that their costs are starting to come down. To be fair, there will be some cost inflation, but overall the trend on most stuff seems to be down. Lower pricing, adjusted for mix, offset by productivity improvement and easier comps on Giga Berlin and Austin. We believe Tesla is passing through peak auto margins right now. And I believe that Morgan Stanley are incorrect. Now, don't get me wrong, I do actually expect over the shorter term margins will come back down a little bit. New ramping factories, cost weighing on that, plus supply chain challenges, materials cost increases and so on. But I actually expect over the long term, as Tesla continues to scale up, benefit from economies of scale, and innovate in manufacturing processes, margins will continue trending toward 30, 35, and then ultimately 40+%. I'm not saying that Tesla wants to have 40+% margins on their vehicles sold, I'm just saying, if the costs keep coming down, they scale up, demand's here, and there's not enough vehicles to meet supply, they may be forced to maintain 35, 40+% margins for a period of time. So I challenge this assumption from Morgan Stanley. I don't believe Tesla is passing through peak automotive margins. I believe in the future, we will see multiple quarters where Tesla's margins massively exceed their current record. Of course, I could be wrong. I'm just some idiot on YouTube. So there's that. We believe there may be greater room for consensus to appreciate the short-term margin headwinds from ramping up 2 gigafactories on 2 continents at the same time in the current environment. Cash flow. We forecast Tesla to generate free cash flow in Q4 of $3.1 billion. By the way, that reminds me of something. So I saw this tweet from one of the paid Tesla shills, the Kool-Aid drinker, definitely on Tesla's payroll, like me, like Dave, like Rob, like, just all of us. Tesla pays us to say these things. Definitely true. Year to date, Q3 2022 earnings comparisons. Government Motors versus Tesla. So let's have a look at this. Government Motors delivered, and by delivered, we mean they left the factories, many of them still in dealerships, not actually sold to customers. So delivered, using the term loosely, 2.613 million vehicles. Tesla, 0.909 million vehicles. GM generated $113.6 billion of revenue on that 2.6 million deliveries. Tesla generated about half that, $57.1 billion, on significantly half as many vehicles. However, this is where gets rather interesting. GM did net income on those deliveries. Over 2.5 million vehicles delivered. Net income just under $8 billion. Not bad. Tesla, on the other hand, less than 1 million vehicles delivered. Net income of 8.86, nearly $9 billion. So hold up a second here. GM delivers, call it, nearly 3 times as many vehicles as Tesla. Yet Tesla makes more money than GM on almost a third of the vehicles sold. Now James has done the math here. GM's profit per vehicle delivery, $3,037. Tesla's $9,761. So obviously, as you can see here, Tesla is just a car company, Mary-led, and it matters. Looking forward, we reduce our 2023 free cash flow forecast to $14.8 billion versus $16.8 billion previously, due primarily to working capital timing, while other factors were mostly offsetting. Price target cut to $330 per share versus $350 per share previously, with bull case and bear case unchanged at $500 and $150 respectively. If you guys want to nerd out on the exact reasoning for the price target changes, pause the video, have a read. Let's move on. A word on share buybacks. I bet I've got a few words on share buybacks to come too. We're not big fans. We tend not to be fans of buybacks in general across the auto industry. I forgot. Tesla's just a car company. I forgot. Yeah, so good point so far, Morgan Stanley. Put Tesla in the automotive industry box, and therefore share buybacks equals bad. Let's read on. Due to high capital intensity and the highly cyclical and competitive nature of the industry, for Tesla specifically, we are less than enthusiastic about share buybacks given the, and here we go, another self-immolation, the other growth opportunities we believe the company has at its disposal. Now, take a moment here. I don't want to be rude, but I do need to get this message across because so many people are saying so many dumb things about this that it defies belief. Let me explain like you're a potato, okay? Tesla is spending as much money as they possibly can, as fast as they can on every project they can possibly conceive of already, yet they've still piled up over $20 billion of cash in the bank and another $3 billion just last quarter alone. There are no other growth opportunities that Tesla can invest in. There are none. They are investing as fast and as aggressively as they possibly can, yet the money still piles up. The question isn't, what project should Tesla not invest in the future? What growth opportunities should they ignore in the future in order to buy back shares? The question is, what should they do with the mountain of money that's piling up after they've invested in everything they possibly can? That is the question. I don't understand why so many Tesla bulls and analysts don't get this basic fact. They can't invest in anything else. The money's going to pile up one way or the other. The question is, do they keep it in cash? Do they buy shitcoin? Do they buy back stock? That's it, okay? This is after they've already invested in everything. They're not idiots, they're not fools. And remember, Tesla is just in its infancy as a money printing machine. 2 years from now, Tesla's going to be putting in $6+ billion in the bank every single quarter, okay? Share buybacks are not taking away from any growth opportunities whatsoever. The second point, and the importance of building up cash reserves to maintain a self-financing status throughout a range of uncertain economic environments. We'll talk more about this in a moment as well. It's also a non-issue, and I really do mean that. This is one of those times when we need to use our brains, not our emotions, and think rather than feel. For the fastest growing EV market specifically, we believe there may be any number of geopolitical, technological, and competitive outcomes that add elevated risk to the outlook. Tesla has a net cash position closing in on $20 billion, which is slightly less than 25% of 2023 projected revenues. Now, I just want to draw the distinction here. Revenues, not profits, revenues. Can you imagine having 25% of next year's revenues just in cash sitting in the bank? That is a lot of money. And less than 3% of its market cap. does its market cap have to do with anything? Anyway, moreover, it is our opinion that the value of an incremental $10 billion of cash on Tesla's balance sheet is worth more than an incremental $10 billion return to shareholders. So we got to talk about this, okay? I know I talked before about thinking instead of emoting and feeling, and this is where we do the thinking part. As I record this, Tesla has enough cash to literally survive more than 3 years if they generated no revenue whatsoever. So imagine an asteroid takes out Shanghai and Fremont and Austin and Berlin. Tesla's fine for literally 3 years, even if they don't rebuild the factories and don't sell a single other product, period, for that entire time. And then 3 years down the track, as they've rebuilt their factories, they can raise a little bit more capital if they want, and they're off to the races. Now, imagining a scenario in which Tesla doesn't produce or sell a single vehicle for literally 3 years. I mean, bro, if that's the situation on planet Earth at that time, there's far bigger things to be worried about than whether or not Tesla can survive a 4th year without producing and selling any vehicles. It's absurd to imagine this as a reasonable scenario. It's important to mitigate risks. You've got to think through, what's the worst case? What if one of our factories does get shut down for a few years? Well, we've got 3 others, so no big deal. And the fact that Tesla already has $20 billion of cash sitting in the bank, and they're putting another $3+ billion in every quarter, means the idea of these share buybacks being a bad call makes no sense. There is no marginal increase in risk to Tesla's existence by doing a $10 billion share buyback over the next couple of years. There's none whatsoever. They're already essentially bulletproof. And I don't want to talk in absolutes, but you have to understand, in order for there to be a scenario in which Tesla had a legitimate chance of going bankrupt because they didn't keep this extra $10 billion in cash, and instead they used it to buy back shares, in order for a scenario like this to actually play out in this universe, we're talking like 1,000,000,000,000 odds. There need to be multiple meteorite impacts. Literally. I just can't see a scenario in which this plays out. And this is where we go back to the whole thinking versus emoting. Some people psychologically, they have this intense fear. They're so petrified everything they do in life. They're riddled with anxiety. What's the worst case? Oh my God, I'm scared to do anything. I'm scared. This is one of those cases. This exact same argument would be being made if Tesla had $30 billion cash in the bank instead of 20. The exact same argument. Now again, I really do want to drive this point home because I'm sick of seeing people sharing their thoughts and opinions about this and me wanting to claw my fucking eyeballs out every time. Tesla just put $3 billion in the bank last quarter. Next quarter, they'll put another $3 billion or more in the bank. That's already 1/3 of a $10 billion buyback. 3 quarters from now, Tesla can replace the entire $10 billion. In fact, it'll only be about 2 quarters, maybe 2.5 quarters, because their profits keep going up. It's not going to take them a decade to get this money back. They're piling up so much cash every single quarter. They need to find uses for it. There's only so much of a cash buffer that makes sense. And I can't understand how people don't get this. I can actually. Emotions clouding judgment. These are the same types of comments you'll hear from somebody who flat out refuses to ever use debt to invest at all because all debt is bad and all debt increases risk, which is a load of horseshit. Says a guy who's currently carrying a couple of $1 million of debt and himself is financially bulletproof. In the past, I've strategically used debt to buy real estate, but not only to buy real estate, to access a huge line of credit, to be able to pull out literally hundreds of thousands of dollars and just put it there, not touch it, but have it available if the shit hits the fan. If I didn't have this debt to draw on, I wouldn't have access to hundreds of thousands of dollars of shit hit the fan money. So I've been able to reduce my own financial risk, make myself financially bulletproof by taking on more debt. Now, some people's brains it won't compute. What do you mean? More debt? That's risky, right? Again, this is where we have to think, not emote. Tesla can't spend the money on anything. It's just going to pile up. So they need to do something with it. The worst possible thing they could do with their money is leave it in cash and allow it to erode due to inflation. Now, sure, you do need some cash buffer. But once you've got enough of a cash buffer, because you've used your brain and thought, okay, current cash flows, future cash flows, worst case outcome, how long can we survive? Okay, blah, blah, blah. Okay, we've got years of runway. That's assuming literally no vehicle sales. That's fucking insane. Okay, how much money do we need? And then what do we do with the extra on top of that after we've already invested in all the growth opportunities? And now, as promised, Elon Musk drops a low-key bomb. Another one of those Tesla Kool-Aid drinkers, Elon bootlickers, posted this. It is insane that Twitter has not currently implemented a YouTube clone. Half my tweets are links to YouTube videos. Twitter does not capture any value here. If users could watch monetized videos on Twitter, Twitter would capture ad revenues and massively increase their profits. And some guy, what's this guy? Who's that? Has anyone heard of this dude? Elon Musk? Replies with a winky face, which I think, let me just put that on Google Translate. Oh, apparently this wink means that's exactly what I'm going to do, bitches. This is actually enormous news. I'm sure many people at YouTube are currently quaking in their boots. I don't know why Twitter hasn't done this already. It's such low-hanging fruit. I mean, it's so obvious. Now, I know I'm an armchair Einstein here. Oh, you should do this, you should do that. But what are they doing? It's so simple. Clone YouTube. Clone Patreon. I mean, bro, such low-hanging fruit. Here's how this should play out. Twitter should allow users to upload content and run ads on that content, just like YouTube. Allow people to search and discover. This isn't to take away from tweets, but in addition, allow video to be monetized. And here's the crazy part. In addition to that, which they're kind of trying a little bit now with Twitter Blue, is to allow people to pay a monthly subscription to access exclusive content as well. 2 models, free ad-supported videos and paid content that doesn't have ads. Clone YouTube, clone Patreon, off to the races. And for the record, ladies and gentlemen, this will happen. I guarantee it. Both models will come. Videos with monetized ads on them and subscribe per month, access exclusive content. And yes, I will be creating exclusive content for Twitter in addition to Patreon. I'm not leaving any of these platforms, but as I said on Twitter recently, it's just like adding another arm to the octopus. My goal here is to create as much value as I possibly can across a bunch of different platforms, and this will be great. Twitter is such a stranded asset at this point in time. Literally half my tweets are click this link to go watch this video on YouTube, and Twitter gets nothing, serving as a conduit to another platform. Of course, step 1 is to get rid of all the useless fucking wankers who currently work at Twitter, which is about 75% of the headcount, also I'm led to believe. And speaking of the useless fucking wankers who currently work at Twitter, I forgot to point out they're also entitled useless fucking wankers. I'm not even kidding, but these morons are literally demanding that Elon doesn't get rid of them. That was the topic of today's exclusive video on Patreon, which was way too spicy to post on YouTube. If you're not already a member on Patreon, you can join with the card in the corner or the link in the pinned comment. Love ya.